Welcome, everyone. We're so excited to have everyone be joining us to look at the Q2 Town Hall. Um, I will say, you taking time out of your busy schedule to come and join us means a lot to Sean and I. Uh, and for those who don't know Sean, he's our associate advisor. Been with us for over a year and a half now, September of 2023, and he's basically if he's not in meetings directly with you, he's behind the scenes preparing everything. We love every work that he does here. And Ryan will not be able to attend, unfortunately. He is doing something amazing. He is onboarding a 401k, and he's really specialized in working with business owners and 401ks. So we're very proud of the work that he's doing as well. So without further ado, I just want to say at the very bottom, give you some just like for the webinar, if you have any questions, go ahead and type them below the video, what you're looking at, the Q&A. It will come back to Sean and I. We could get those addressed as we go through the conversation. Okay, so that we'll have that. The other thing would be going forward in town halls, right? If you want anything in particular addressed, go ahead and submit those questions to our team, CHS at primefinancial.com. Those emails come into us. We're able to compile those questions so that when we have the town hall, we could address what's on your hearts and minds. Otherwise, we just get right into what we prepared for. Okay, so no questions came in for this one. That doesn't mean it won't happen in the future. So think about those questions as we send out the information, as you register, we'll get them addressed. So I just like to start off, if you see me look to the left, I'm just looking at what I'm sharing on my screen, and it's just that why do we have that a team approach? It's just two are better than one, right? Because with a good return of their labor, a cord of three strands is not quickly broken. There's times where we're preparing for one of your meetings, and Ryan or Sean will go, "Hey, have you considered, or should we look at?" I love that, right? You're not just subject to one person's great or bad ideas, right? You're having that team approach, multiple perspectives coming in, really allows us to elevate the service. And I'm so proud of that. And if you look over to the team credentials, I love that. It's not about alphabet soup behind our name. That's not what we're here for. But it's really going like, okay, when you're trusting your financial future to a team, what do they bring into the table? What experience do they have and how they can help? I was meeting with someone earlier today and they were going into their son going into college. Well, Sean's credential was a certified student loan professional. Great opportunity for Sean to have a valuable conversation with this 17-year-old son that's going into college about student loans and how does that play into financial planning so they don't come out of college being buried in debt, right? What does that look like? How does that play out? And then our clients who are already out of college and they're still paying student loans, our clients that are 30s and some in our 40s. That's what Sean's in those meetings to make sure we're talking through that as well. So by having these kind of credentials is to really make sure we're looking at this holistic. Okay. Now I kind of also did that for those who are kind of straggling in. Okay, so thank you for those who came here at 4 o'clock. But let's get into private investments. This is the main crux of this meeting. Not to say we don't have others. We have spring cleaning agenda items as well for y'all. And we're going to send you a follow-up email that's going to have some of these attachments, okay? But what is private investments? It's a common question that we get quite a bit when we introduce the concept of PPP. P being public market, the next P being private market, and the last one being protected. Well, for those who heard this conversation before, when we do our meetings and we are looking at the volatility within your portfolio, because we had a well-diversified strategy within the PPP, you're weathering this environment pretty well, right? So this is why we wanted to go back and go deeper dive into the private markets. As you see here, it's not just one thing. It's pretty diverse. You have private equity. So when you think of like stock, buying into a stock market, well, obviously, when you're buying into that, you're buying into equity. You own a portion of that publicly traded company. It's the same thing for a privately held company. Okay. venture capital, think these are very small companies. They're starting out. So they may not have economic data, right? It could be higher risk, high reward kind of situation, but definitely higher risk. Then you have private debt, private credit comes into that, okay? Private debt is like a bond side of it. Private credit is like a line of credit that's issued to the business. Then you have private real estate, infrastructure investments, hedge funds, and then the situational, we don't do too often in a front office. Typically, the client has to have well above $5 million to get into situational. So it can happen, but that's when we do like litigation finance. It's very nuanced. So I'm not going to spend a lot of time on that. We're going to focus mostly on like private equity, private credit, private debt, things of that nature. Okay. So as we go into why are we having this part of the conversation, I love this slide. Now, okay, you could definitely send us feedback on the graphics. This was me trying to work on it at nights and weekends. Okay, so I did my best. I'll put it there. So I know the colors are not exactly color coded, but I'm looking at the data, not all the other stuff on it. But look at over here, the number of listed US companies and market cap. What is this busy chart right here that I'm pointing at? I'm kind of circling. What is that showing you? Is we have less and less publicly traded companies in the US market. Look at how that has really significantly dropped from the late 90s. So what's going on is the companies that are publicly traded, their market capitalization, how large they are, is significantly increasing over time. And you can see that on the orange line there. Okay, now the average market value and median age of IPO, initial public offering. So these are privately held companies that are going through the IPO to then become a publicly traded company. I find this fascinating, right? Like, okay, what does the data show? The data shows, well, the median age in the 90s, in the 80s and 90s, they've been around for a while. They've been around for 8+ years, indicated in these orange diamonds. But when they went out to market, their market value was pretty low, right? Now they're waiting way longer. Privately held companies, they're going, no, I'm going to stay longer on the private side of the equation. I don't want to go public, right? And they're doing it on average 11 years of being in the private equity space. Now, there's many reasons to this, and I'll dive into a few today, but I want to go into this next one on the right, just going, what is private equity versus the small cap sector? So if you think of small cap sector, think of like the Russell 2000 index. That's the index that tracks mid and small size companies, okay? And if you look at the Russell 2000, 14% of that index is invested in tech. However, if you look at the private equity market, 36% is in tech. It's pretty big, right? Of a disparity there. Consumer discretionary, that's what that disc is consumer discretionary spending. That's 11% each. But then you see communication services, you see private equity be well above the 2%, right? So you're seeing that as it goes down, there's some of those changes. Financials being at 17% versus 9% for private equity. What it's just saying here is, if you think tech is going to have a long runway for a longer period of time, there's companies that are in the tech sector that are not publicly traded, that they're waiting to grow larger before they go into to become publicly traded. Now, I'm just going to give my 2 cents here, okay? This is not scripted. I'm just kind of freestyling about why I believe this is happening, about why are these companies staying longer on the private side versus going public. So not only longer, but getting very large as well before they go public, is when they're a younger firm, what they want to do is make R&D investments. They want to invest back into their business so that they can have that longer term growth. Okay. Well, if they're on the publicly traded exchange and they're saying, hey, we're not going to reinvest back into, we're not going to, we're going to take this extra money and we're not going to expand. We're going to put that to shareholder value. It's going to go to the stock price. Well, people are going to love it, right? But how do they stay competitive in that environment? That's where a lot of these companies kind of struggle within, right? So what they're doing instead is they're like, listen, we want investors. So on the private equity side, you could go into like interval funds where you could get in, but you have to wait on a quarterly basis. They're also called like evergreen funds. You could do those kind of things. But if you go into like a pure private equity investment, it could be 5, 7, 10 years before you could get your money out of it. So what ends up happening, right, is you put money in, they take that money and then they invest into their business. They invest that money that you're putting into their strategy so they could do the R&D, they could grow their business. And in that, they know they don't have to, like, they give quarterly updates, don't get me wrong, they do. But most of them, they're saying, okay, these are long-term investors that are not going to need their money for 7 years. We could go ahead and invest, take that hit now so we can have that growth on the back end. Once they go public, could you imagine a CEO, Sean, on an earnings call saying, hey, we're going to dilute our shares, we're going to lower the stock price so we could go and do this security protocol, or we could do this or that, but it's going to be great. You're going to love us 3 to 5 years from now. How do you think that will play out?
It wouldn't go well.
I think by the time the CEO goes back to their office, they're going to be out of a job, and a new CEO will come in and go, and yeah, we're not going to do anything that person said. We're going to do this instead, right? So unfortunately, with the public market, this is the benefit of the public market is liquidity. If you need to get access to your money, you could get access to your money in the public market, but so can everybody else. Right? So everyone else could get also access. That creates a lot of volatility and knee-jerk reaction. Because I didn't get any questions on the economy, I'm just going to talk about a knee-jerk reaction that we all saw. We saw the market pulling back quite a bit, and there was this fake news that got circulated. Imagine that, fake news got circulated about the tariffs being on a moratorium, being pushed out. Stock market popped. Then the real news came out saying, no, that was not true. That was maybe pressed too early to call it, and the stock market pulled back. Okay, so what does that tell me? Knee-jerk reaction, and they're trading on the news is what they were doing, right? In a public market, because you and others can't liquidate, it's held up into the private investments, right? Well, you don't have that knee-jerk reaction. There's other things that we have to discuss, and I'm going to get into that as well. But this is where having a well-diversified portfolio with PPP, public, private, and protected, comes into play to navigate this environment. So let me get into this. This is when you introduce money, other investments into a strategy, you're looking at increasing returns, right? That's the goal, but also managing the volatility. Now, this is a busy chart. Thank you for bearing with me. I'll walk you through it. I'm not going to go line by line because we'll be here all day and you guys have other things to do. But a correlation of 1 all the way down to a -1. If something has a -1 correlation to another strategy, another investment theory, it's just saying if this goes up 5%, that one that has a -1 goes up 5%. It's a 1-for-1 negative correlation. So we call it correlation coefficient. This is a very geeky thing that, I'm not trying to geek out on you here. It's just saying this. If you look at US large cap, that's the S&P 500, large companies here, publicly traded. If you go through here, you see the international index has a high correlation to the US market. Emerging markets have a high correlation, but do you see bonds? I know they're not negative, but do you see how they're really low and closer to 0? It's just showing that they offer a hedge. They offer a volatility help. Now, how can I say that with confidence? Is look at over here to the right, the annualized volatility. So what you see here is on large caps is 16% on the standard deviation, which is the volatility. But look at bonds being here at 5. Now I find this to be fascinating too. Look at high yield corporate bonds. Another word for high yield is also known as junk bonds. I'm not saying that these companies are not good companies. It's just that their cash flow and how they're evaluated is saying, okay, look, like they could pay, but they have a little bit higher risk, and so they're going to be a high yield bond. But do you see how a corporate high yield bond has a high correlation to US large caps? So what this tells Sean and I is with the lower volatility, corporate high yield has 9 to the 16. We could do high quality government and municipal bonds. Here's the munis, here's the corporate bonds that have a coalition coefficient, right? It allows us to manage your overall volatility and a risk within your portfolio. Okay, let me go back into the private investments. You see here we have hedge funds and private equity. Do you see how they're as positively correlated as high yield bonds are, right? And emerging markets are? So there is that positive correlation. So that's the thing that I just want to talk through, right? Is we are looking at what kind of volatility they have. And you see the hedge funds have a 5 and private equity is coming in at the annualized volatility of a 0. Well, why is that? It's just because the holding periods are 5, 7 to 10 years out, right? So it smooths out the volatility. Okay, busy chart, but it was one of those things where we look at this behind the scenes, and part of the town hall is how do we show you what we're doing behind the scenes? So when we present a portfolio or a recommendation, we're taking all this into account so that when you see it, you see the simple number of a Riskalyze score showing you a 56. Well, we don't look at that purely. We look at this kind of data to then get to that and then show you the easier, more simplified version of this at a Riskalyze score, okay? One of the most important parts of this presentation is this chart right here, okay? This, as far as I could say, okay, everybody I've ever served, including myself and Sean, we want to be to the very top left of this chart. Let me walk you through what we're looking at. On the left-hand side, we have the annualized returns going up and down, and then we have on horizon the annualized volatility. Okay, why would everybody want to be on the very top left-hand side? That means you're taking on low risk, low volatility, and getting absolutely amazing returns. Wouldn't that be great? It's also known as a unicorn. Doesn't exist. Unless you could bring one to the office, it doesn't exist, okay? Could you imagine Sean shows up with a unicorn? I could see we're going to get unicorns mailed to us or something, right? Okay, let's look at someone who has an 80% stock, 20% bond portfolio, all public market. What am I showing you on this? The volatility is coming in at 12.5, pretty high. It's the highest on this chart. What are you getting as far as returns? 9.875, 9.8. That's the annualized returns. This is from 1998 to 2021. I think we all could agree that's a long period of time for this kind of analysis. So what happened here? We then threw in 30% going into alternatives, 10% into hedge funds, 10% into real estate, and 10% into private equity. That's what we did. If you look at that, we took that from the stock side of the equation, not the bonds. The bonds stayed at 20%, and what happened with that portfolio? It moved up into the left, which is, again, what we're striving to do when we have a well-diversified PPP strategy. So what did it do on this? 30% alts, 50 equity, 20 bonds. Look at the volatility. The volatility at 9.35 is basically Give me some grace. The exact same volatility that we're seeing from a publicly traded 60/40 portfolio. I'll let that sink in for a moment. You're taking on the same amount of risk, but your return on the 60/40 comes in at 9% annualized versus just shy of 10% by incorporating the private investments. Okay, what about a 60/40, Sean? Does that also move up to the top left? You're seeing that. It doesn't do it as drastic, right? So you're seeing it still moves up to the top left. So what does it tell me? Even with someone who's super duper conservative, right? We're using very technical terms, super duper, right? Just trying to have fun as we do this town hall. 40% equity, 60% bonds, publicly traded, they still move up and to the left. So they are taking on slightly less risk, but they're getting additional rate of return by doing it. And you see a 30% stock, 40% bond, 30% alternative is getting similar returns to a full publicly traded 60% stock, 40% bond portfolio.
And Jason, we do have one really good question, which came at a perfect time. Someone asked, why not put nearly all my money into these private investments if we can improve this chart so much just by putting 30% into alternatives? Why not do 60, 70, 80%?
Strong, solid question. Just like in our one-on-one, sometimes I have to like really comprehend and think through it. When it's actually, that's an easier question to answer in a one-on-one. But let me talk about it at town hall level. Okay. It's the illiquidity. It's the illiquidity. So if you, let's say you put 60, 70, 80% into private investments and then some life happens. Sean and I see this every single day. We have people that come in and they tell us very serious things that are happening in their life and loved ones' lives. And then that usually follows up with, I need some extra money, right? If we put too much into the private investments, we may be able to liquidate, but that liquidation event could happen in like June, July. And they're like, well, I need the money now. Okay, well, then the counter arguments, well, I still have 20, 30, 40% in liquid assets. Well, yeah, well, it depends on your size. Depends on how much money you have. That's one part. That's the first thing that comes to mind. The second part is there's minimum investments within these private investments. Like for instance, there's one investment that we go into with our clients that has $1 million minimum investment. I just feel like doing this. I don't know why, but $1 million minimum investment. However, we negotiated with that firm for a $50,000 minimum investment for our client. So there's that aspect as well. And you don't want to put all your eggs in one basket, right? You could really diversify private equity and private bonds and private credit, right? You could have a well-diversified private strategy. That's really important. It's just going into, when we look at the data on this, it's meant to complement and not to replace. Okay. Now, as we're going through this town hall, I know you're taking notes, right? Because you work with us, you're taking notes, you're highly engaged. If you're going, how does this play into my account specifically? This is where, reach out, we'll schedule a meeting and talk about this specifically. Here's another thing that I wanted to just touch on. Most Americans, we acquire our wealth through our home and our 401k. And what makes me madder than a hornet's nest is inside of 401ks, there are no investment choices for private investments. It's all publicly traded investments. So that's what we all come to know and understand. But private investments can be bought inside of brokerage accounts at your Fidelity or Schwab accounts that we have for you, right? We can buy that inside of IRAs. We can buy these investments inside of trusts and brokerage accounts. Now, where do we put those private investments could also have tax implications. So we have to do that the right way, the prudent way. We walk you through that on a one-on-one conversation. Yes. So why do I feel like so many people are at the 80-20 or 60-40? It's because their money's tied up in the 401k. They can't even get to these private investments or other investments like protected assets until they separate from service, until they retire, or until they change jobs, right? The other way is they got to be saving money into their Schwab account, like their cash management account or their joint account, right? Trust, to then be able to get into this. But it's a really good question. And I go back to my first answer, liquidity. Sean, thumbs up on that, or do you want to add
Yeah,
anything to that?
no, I agree. The only other thing I would add is that, at the end of the day, public equities historically do very well. So we always
Mhm.
want to have some exposure to the public market. It's not to put the public market down. It's just to understand that we can lower volatility while still keep that upside by having access to both public and private markets as well as protected.
I would say with the Q&A below, keep on asking questions as we go through, and Sean will do what he just did. He will hit me with a great question that you have for us, okay? So as we go through, go ahead and chat those questions that Sean and I could see and we could get it addressed. I think this is a good segue as well to maybe why, okay? It's about manager selection. If you look at the public market, we're showing you what the median is on the diamond there, and then we're showing you the percentile, right? What is going on within like the top of the top quartile to the worst quartile. And you're seeing on the public market, global large caps, global bonds, US core real estate, the dispersion of what's a good manager versus a poor manager is pretty tight, pretty narrow. A lot of people are just coming right in at that median return. Okay, now we look at the private side of the equation. Look at that dispersion on private equity. There's private equity out there that's coming in at 1.6. This is based on returns from Q4 of 2014 all the way through Q4 of last year. Okay, so it's showing you that 10-year time frame. And so think about that, an annualized return of 1.6 because the private equity manager had a really poor private strategy, right? So we have a chief investment officer at our firm. We have a director of private investments. It's a 26-week thing that they put private investments through. When I say thing, it's just really a well thought out like questionnaire. We're really looking at their financials, their investment thesis, how long have they been working in the private space, right? All those come into play. And so what I challenge this chief investment officer and director of private investments is get me near the median. Get me near the median. And if you could impress my clients and get in above the median, perfect. Right? What does that look like? Right? But if you could get us near the median, then we're doing better than what's going on in the public stock market. Do you see how the median is still better than the public stock market? On the private credit side, look at the global private credit. Look at that median versus the global bonds. Typically, when we're discussing private credit with our clients, we're saying we should be getting a 4 to 5% better yield than what we could get in the public market. Well, this chart shows you that. So why do we not put all your money in private equity or private credit? Well, we still may need liquidity from your bonds, right? So there's that aspect of it, okay? Do you see what I was talking about VCs, venture capital in the very beginning? I brought it back. I'm not very happy with that median return, right? So there's probably a reason why I haven't had a venture capital conversation with the majority on this in this town hall. Okay, it's because of this chart right here. Hedge funds, the problem I have with hedge funds is they're very costly and they have a lower barrier of entry. $250,000 minimum, and they typically charge 1.5% per year for the investment management, along with another 1.5% of any returns. So I mean, high fee on there. I think there's other things that Sean and I could do, like collar strategies, hedging strategy, structured notes that could provide us a hedge that we want and really minimize that cost. Okay. So thank you for letting me just talk through the hedge funds on that. Now, Sean, any questions that came in before I go right into the key items going into spring cleaning?
No, we had one quick one just asking about Blackstone, and that is private, not protected and not public. So Blackstone's would be considered private. That was the only other question for now, though.
Yeah, so Blackstone is to your point, most likely private credit or private real estate are the things that we discuss with our clients. Like private credit, awesome, right? You're looking at yields that are 9 to 10%. But in a taxable account, they're taxed as ordinary income, right? So we lean to put that in more into IRAs because, well, you get the tax deferred status. Yeah, you gotta pay income on it down the road, but if you're in a high bracket, we will most likely put private credit into your IRA. If you're in a lower bracket, we may consider putting that into a taxable account. But private real estate, the majority of that is not subject to income tax because of the depreciation of the real estate. Again, this gets pretty sophisticated and really good for one-on-one meetings for sure. But you get a tax benefit. So we got to look at what's your tax equivalent yield when we're making these recommendations for what's called asset location. Okay, we want to put this asset into the portfolio, but what account? Taxable versus IRA, Roth, that's what location comes into play. Okay. So let's talk about beneficiary audit. Now you're going to see that I made this presentation on the next couple of slides, so bear with me. Okay. But I was a little proud because I don't work with presentations too often, but the job needed to be get done, so we got it done. So we're going to talk about beneficiary audit. There's going to be a poll that we're going to send out. Okay, we want you to answer this poll. Active engagement within the meeting about when's the last time you did your beneficiary audit. So you got that on your screen right now. Go ahead and start answering that so we could get that feedback. We're also going to talk through issues to consider during a market correction. Okay, I'll pull that up on the screen so we have that. Let me move that over here. And then the last thing that we're going to look, not the last thing, but should you do a Roth conversion? We're going to look at that, right? So Sean, do me a favor. Let's have Caroline send me issues to consider during market correction. So we'll be able to get working on that. Okay. So let's talk about beneficiary audit. This is a fun chart. You can see I made this, right, Sean? Oh my gosh. Well, per capita and per stirpes, nothing like getting into Latin as we talk about beneficiaries. But this is important terms and very important when it comes to estate planning. Okay. So per capita, let's just look at the left-hand side. We have this individual, they ended up passing away, but before they pass away, their beneficiary, they have two beneficiaries. The beneficiary on the left that has two children, they pass away before their parent does, before the owner of the account. So what happens with the money? Look at this. You see the money bags? I'm so happy with that graphic, Sean, right? All the money goes to this person. So we'll just call this Timmy and Johnny. Timmy and Johnny, they don't get anything because we did per capita. Okay. But on per stirpes, in this situation, the same beneficiary passes away, right, before this person does. The remaining primary beneficiary, they get 50% of the funds. So let's say it's $1 million, they get 500,000. But because this individual here at the top of the funnel, they said, I want to have both of my beneficiaries to be per stirpes. So Sean, I love Sean. I put Sean as my contingent as a primary beneficiary with my wife Rachel. She's gonna love this example. Hi, honey. Okay, so Sean, I did in my account 50% to my wife, 50% to you, and I do a per stirpies on my wife and you. In the event that one of you passes away, then it will go to your beneficiaries. Pretty cool, right? So a fourth, they get 50%. They split their 50% equally. So if I added one more graphic here, they each will get a third, a third, a third. But this individual over here, they get their portion. All this stuff is really important to go through. And then it was like, you know what? I really wanted to go, okay, here's some like things to consider. Do you want only living beneficiaries to inherit? If that's the case, you're going to want to do per capita. But do you want a deceased beneficiary shares to go to the children? Well, if that's the case, you want per stirpies. Where does this really come into play is you have a beneficiary that passes away before you. You could take proactive measures to update your beneficiary. Hence why it's important to do the beneficiary audit, right? A major life change, a marriage, divorce, new child, right? Go in and update the beneficiaries. I'm so happy to see 50% did it within the last 6 months, 22 did it within the last year, and then 28 did it within the last 1 to 3 years. That's wonderful, right? Caroline in our office also does beneficiary audits, and if she sees something, she reaches out to say, hey, do we need to take a look at this? Good stuff. Do you want each generation to inherit equally? If that's the case, per capita. Do you want to avoid complexity in multi-generational inheritance? Per capita. Do you want to prevent distant relatives or minors from receiving assets? Per capita. Okay. This is a conversation with your financial advisor. This is a conversation with your estate plan attorney. Okay. Nothing with beneficiary audit is who do you have as your beneficiaries on your IRAs, on your Roth, on your 401k. Okay. Like a lot of times you want to avoid putting a trust as your beneficiary in those types of accounts. I'm giving you general rules of thumb here. I'm not speaking to anyone out there specifically, but if you have a trust as your beneficiary on an IRA, there's a good chance we had a very long conversation about that. If you were thinking about putting a trust as a beneficiary, well, the problem with that is the trust and estate laws have compressed taxes and restrictions within it. So you could be unintentionally causing a major tax issue for your beneficiary. So this is really around the Secure Act laws that came out going into, there's no more stretch IRAs. You got to take the money out within 10 years, but if it's a trust, it could be within 5 years. So we'll talk, well, I like the market correction for the last question. So should I consider a Roth conversion? Well, go figure. I'm smarter than I give myself credit to, Sean. Key issues to consider during a market correction. Number one is cash flow issues. And you see we got some questions there, right? Is your cash flow tight? Do you have an appropriate amount in your emergency funds? What does that look like? Is there any disruption issues that could be happening with employment? We understand that there's already firms downsizing. If you're in that situation, reach out. Let's have a meeting. Planning to retire sooner. You're like, I just can't take it, right? Other people are being laid off. I have more on my plate. Can I get out of here, right? There's that. Okay, assets and debt issues. Do you need to rebalance your investments? Extra cash that's not earmarked. Maybe that goes into buying in at a lower price point. Contribute to an IRA or Roth. That money comes in. Now you can have that growth within those accounts, tax deferred, tax free if it's the Roth after 5 years or 59.5, right? Do you have debt that can be refinanced? We see that going on with lower interest rates. I'm not talking to you that has the mortgages at 2.5%, 3%. We probably will never see that again, but I will never say never, right, Sean? So, but maybe not refinance debt, but think of higher interest rate debt that maybe it could be refied. tax planning issues, Roth conversions, we bolded that one, so we're gonna go more into detail there. There's also consider tax loss harvesting. It's a way that you can make lemonade out of lemon. Okay, and we have tax loss harvesting strategies deployed in quite a few of our accounts. Again, all talking points if we haven't already, and that's for only taxable accounts. We can't tax loss harvest your IRAs or 401k. If we could, we would, but we can't. That next is long-term planning. What is your annual gifting strategy? Can you help family members? Maybe update your estate. One of the things that we like to provide is decision trees or checklists. We like to do that because it takes what's complicated and simplifies it as much as we can. This right here is a checklist of issues that you should be considering for your beneficiaries. Got that twice, and I'll get the other one for market corrections as soon as I get it. Okay, so we'll get Caroline will send that over to me as soon as she can. Thank you, Sean. Okay, Roth conversions. Roth conversions. You have an IRA balance of 100,000. IRA drops down to 75,000. We didn't do PPP or fully public market exposure with market volatility down to that, so you lost 25%. What they're saying is you convert that money during a market correction over to the Roth. The market rebounds. Now you have that $25,000 in growth that avoids the taxation. What I mean by that taxation is you did the Roth conversion. You have to wait 5 years on that growth or 59.5, whatever comes later. You could touch that much money plus the growth tax-free. But if we did the Roth conversion, you got to pay taxes in the year that we do that. So you got to pay ordinary income taxes on that 75,000. Okay. But let's say in this case, Sean, something comes up, somehow they just got hit hard. I mean, they had to deplete their emergency savings, and then they had another thing that came up and they need another 20,000. Could we withdraw, not to say we would want to, but could we withdraw 20,000 out of this Roth IRA that we converted?
Yes, absolutely. You could take out the amount you contribute. So it's the earnings that we'd have to wait on, like Jason said, the 5 years or 59.5, whichever's later.
So could we get $20,000 out to them from this Roth conversion?
Yep.
And how much would they have to pay in taxes?
Nothing, because they've already paid the taxes on it.
They pay the taxes during the Roth conversion, right?
Yep.
So that 75,000 can be withdrawn. Please don't walk away going, oh, well, we'll just do Roth conversions and have that as our emergency backup. No, you still have emergency funds. They get depleted. Life is coming at you hard. We all know what I'm talking about, okay? And you still need a little bit of extra money to get through that rough patch. We have this Roth conversion assets that we could do that with. Okay, so it's part of a consideration during market volatility to convert when the market's down. Okay. And then we have our disclosures. Hey, I love our lawyers page, right? Now, Sean's going to be sending out another questionnaire about the quality of this town hall. But as Sean's doing that, I'm going to go into some of these decision trees. Okay. So this is a checklist that we are going to send out to everyone who's attended. Okay. This is one of them. This is a checklist that you could go through at your leisure to make sure you have a well thought out beneficiary audit. Pretty cool, right? I like this a lot. Where should my next dollar go? I just wanted to go right into this decision tree. I like this. Are you financially secure? Yes or no? No? Okay. Bolster your emergency savings, paying off additional debts and increase your insurance coverage. Okay, so there's that no. Let's say you say yes, come down here. Have you taken advantage of all the free money available from employee matching and things of that nature? The answer is yes. Okay, now come back up here. I like this decision tree. What should I do with my next dollar? I'm really gonna focus on my cash flow. I got this money coming in, I got money going out, I got this extra money. What should I do? Either enroll in portfolio payday or go through this. Okay, let's go into Should I consider a Roth conversion? Every single year I have to update this chart because every single year there's tax law changes and what we could be doing and things of consideration. With that being said, I like to do this decision tree. He's either Sean and I do this decision tree in preparation, but if we're like 50-50, we don't know if we should or shouldn't have the conversation. We like to do it with you, right? Those who've been through this experience, you know what I'm talking about. You get your own copy, we keep a copy, we submit it, we put it part of your notes so we all know what we discussed and what was decided. But what I like on this is just going into, okay, here's your consideration, but be mindful of this, right? Yes, consider doing a Roth conversion, but be mindful of this. If you go through this and you're like, I really am interested in this IRMA thing that you guys are talking about, we also have decision trees for that as well. It just really helps us look at this holistically. And as far as the market correction, which I think is one of the more important ones, Sean, do you have that chart?
I have not gotten it from Caroline yet, but we'll make sure we email that one out.
Caroline's probably helping someone right now. I'll get it for everyone. Your feedback really means a lot to us, so that if you think there's something that we could be doing different or better in these town halls, right? This is where sending us like what you think we should be talking about so we can make it timely and beneficial to you. The other thing is we're doing the monthly newsletters, talking about what's going on with the market, the tariffs. We were having conversations over tariff talks quite a while ago. So those are the things that we're looking at doing to help our clients make better informed financial decisions. And you're hearing directly from Sean and I about what we're seeing, how we're looking at it. And in those newsletters, we're giving you not just a video with the charts, but also you could read it if you rather read it rather than watching us talk for 3 to 4 minutes. Okay. Sean, I'll wait for additional questions to come in. But know that everyone that was attended, we will send these decision trees along with key considerations during market corrections. So you also have that decision tree and checklist as well. Sean, any questions?
No, not seeing anything else, but a lot of feedback, which is great.
All right. For those who want to, reach out to Team CHS so we can get a meeting scheduled, right? Send us what you want us to go in more in depth in so we can make sure we tailor that meeting to what's around your focal point. Lastly, I'll just say, because I don't see any questions coming in, share the registration with other people that you think could benefit from these town halls. We always invite all of our clients, but you have friends, family, coworkers, neighbors, people you don't like, go ahead and forward it on. Just let us know if you don't like them. Maybe they won't get the link. But anyway, just forward it on, right? Because they may pull one thing out of this meeting and they can make a better informed decision all because they attended. So we hope you like. Thank you for your feedback. I'm seeing very positive feedback. We always want to get better. Okay. That's our strive. It's our core value of continual learning and focus on improvement. Hold us to that. We're here for you. Thank you so much for joining. We appreciate it and have a great Thursday.
Thanks, everyone.
Thank you for those questions that are coming in. Yes, those who sent those questions, we will reach out to you around those comments. Yep, you got it. You can see I'm not saying any names because we protect the innocent here. Sean, you saw those questions as well.
I did, yep.
Thank you so much for those beautiful comments about the peek behind the curtains and your genuine thank you. Thank you so much. We appreciate that. Okay, let's have a great day. Take care.